Okay, let's just unpack this for a second. If you ask 10 different people what profit is, you'll probably get, what, 10 different answers.
Oh, at least. You'll hear net income, revenue minus costs, maybe even just the cash that's left over at the end of the month.
Right. But in the world of financial reporting, profit isn't just one thing. It's more like a hierarchy, a stack of really specific numbers, and each one tells a very different story about a company's health.
That's the key right there. It's a story told in layers. You can be profitable at one level of this financial architecture and facing a total disaster at another.
So companies don't just calculate one bottom line.
Not at all. They track these distinct profitability milestones. And understanding that structure, the steps they take to get from a single dollar of sales all the way down to a dollar they can keep, that's really the prerequisite to understanding what's going on.
And that's our mission for this deep dive. We're going to walk you through that exact hierarchy. We're going to start with the philosophical foundation of profit, if you can believe it, and take it right through to the bottom line. And then maybe even a little bit beyond.
We have to start there. We have to start with that abstract foundational idea because every single number we're about to look at rests on it. It's called financial capital maintenance.
That sounds incredibly academic.
It does, but the core idea is actually, pretty straightforward.
Okay, so break it down for us. What does financial capital maintenance actually dictate?
It dictates the definition of income itself. So, simply put, a company has generated income only when the dollar amount of its net assets, that's just assets minus liabilities, what we call owner's equity, only when that amount increases during a period.
But that increase can't just be because the owners decided to, I don't know, put more money into the company,
Yeah.
right?
Exactly. That's the crucial exclusion. We have to exclude any increases that come from owners investing more, and we also exclude any decreases from the company paying out dividends to those owners.
So the growth in net assets has to be organic. It has to be generated from the company's own activities.
From its economic activities, it's about measuring true growth from within.
Now, here's the part that I think is so important, and it's a choice that's sort of baked into the entire U.S. reporting system. Financial capital maintenance, as it stands, focuses on the nominal dollar increase.
This is a huge distinction, a massive one. When we calculate income under current U.S. GAAP, we are, by definition, ignoring the effects of inflation. We're ignoring changes in purchasing power.
So if a company's assets go up in value just because the dollar got weaker, the system treats that the same as if they'd actually, sold more product.
In theory, yes, that nominal gain isn't treated any differently from a real substantive gain from operations.
I think I remember from our source material that this wasn't always the thinking. Didn't the U.S. system try to adjust for inflation at some point?
They did, yeah. Back in the 70s and 80s, when we had that crazy high inflation, the Financial Accounting Standards Board actually mandated a period of supplementary inflation-adjusted reporting.
To give investors a truer sense of earnings.
That was the goal, to adjust for the eroding power of the dollar.
So why did they stop? I mean, it seems like a good idea. Shouldn't we always try to calculate income in terms of real purchasing power?
Well, it was just really complex and controversial. I mean, first, once inflation died down in the 90s, the need just felt less urgent. But also, moving away from nominal dollars, it introduces subjectivity.
How so?
You have to pick an inflation index, for one, and then you have to debate what you're even trying to maintain. Is it physical capital, general purchasing power? Ultimately, the nominal dollar concept won out because it's practical, it's objective, and it's just simpler to apply to every company.
And that's a huge takeaway for you, the listener. Every number we are about to discuss, gross profit, operating income, net income, it's all built on this idea that a dollar today is the same as a dollar a year ago. It's the rule, but it's a rule with a very clear limitation.
Absolutely. So now that we have that foundation, we can actually build on it. We can look at the structure of the multiple-step income statement, which is designed specifically to separate those core business activities from everything else.
Okay, let's start that journey. We'll use the data from Sample Company, Inc. to make this concrete. Where do we begin?
We begin at the very top with the most basic measure of product profitability, gross profit.
Level 1, gross profit. So Sample Company had $1 million in net sales revenue. That's the top line.
The money coming in the door. But to get those sales, they had a cost of goods sold, or COGS, of $600,000.
So you take the million, subtract the $600,000 in COGS, and you're left with a gross profit of $400,000.
And this is that first critical hurdle. What gross profit measures is just the initial efficiency of the core business. Can they make or buy their product at a price that leaves enough room to cover everything else? If this number is too low, the whole model is basically broken from the start.
Okay, so that's the product's profitability. Moving down, we get to the profitability of running the whole organization. Level 2, operating income.
Sometimes called EBIT earnings before interest and taxes.
Right.
And to get there, we take that $400,000 gross profit and we subtract all the total operating expenses.
Which is everything else required to run the business day to day, right? The stuff that isn't the product itself, the office, the salespeople.
Exactly.
Yeah.
Our sources show sample company had things like wages and salaries, rent expense, depreciation expense, the steady, unavoidable costs. For them, it all added up to $300,000.
So, 400,000 gross profit minus 300,000 in operating expenses leaves us with an operating income of $100,000. Yeah.
Now, stop right there. If you are an investor or an analyst, this $100,000 figure is. It's arguably the most insightful number on the entire statement.
Really? More than the final bottom line net income figure. Why is that?
Because it gives you the purest view of the business model success. It excludes interest and taxes, so it completely levels the playing field.
What do you mean by that?
Well, imagine comparing two trucking companies. One owns all its trucks, has no debt. The other one leases everything and has massive interest payments. Their net incomes would look totally different.
Okay.
But their EBIT, their operating income, lets you compare how good they are at the actual job of moving stuff around, totally separate from how they finance their trucks or what their tax situation is.
Oh, so you're isolating management's operational skill. You're removing the variables of, how they fund the company and where they pay their taxes.
Exactly. It's what management has the most direct control over. It's the key metric for comparing a company to its peers. It tells you if the business, sort of in a vacuum, is viable.
Got it. Okay, so once we've established that core profitability, then we bring back those other elements. That takes us to level 3, income before taxes.
Right. And this is where we account for all the other stuff, the peripheral revenues and expenses that aren't core to just selling the product. We start with that $100,000 in operating income.
And Sample Company had some of this. They earned $5,000 in interest income, maybe from cash they had sitting in the bank.
But they also paid a pretty hefty interest expense of $25,000 on their debt.
So that's a net outflow of $20,000 in financing costs. You subtract that from the operating income, and you get an income before taxes of $80,000.
And that $80,000 is the measure of total profit from all activities, core operations and peripheral financing, just before the government takes its slice.
Which brings us to level 4, the big one, the number that gets all the headlines, net income, the famous bottom line.
To get there, it's one final mandatory deduction. We take that $80,000 of income before taxes and we subtract the income tax expense.
Which, for our example, was $30,000.
Leaving the company with a net income of $50,000.
And this $50,000, this is the figure that, for most people, defines success.
Yeah.
It's what's used to calculate earnings per share. It's the number that ultimately gets closed out to retained earnings on the balance sheet.
It is. It increases the owner's equity, which brings us full circle back to that financial capital maintenance idea we started with.
But wait, there's a crucial detail here about how this was all calculated that we need to mention.
Yes. We absolutely do. Remember, this entire architecture, from the $1 million in sales down to this $50,000 in net income, it all relies on something called accrual accounting.
And why is that so important to bring up right now?
Because the whole income statement is an estimate of economic performance. It's not a statement of cash flow.
Meaning revenues are recorded when they're earned, not when the cash comes in.
And expenses are recorded when they're incurred, not when you actually pay the bill. That $50,000 in net income is an economic reality, but it does not mean the company has $50,000 of cash in the bank.
Right. They could be waiting on a huge payment from a customer, or maybe they paid all their expenses up front.
Exactly. It's the fundamental difference between what's happening on paper and what's in the bank, and that's a layer that underpins this entire statement.
That makes perfect sense. Okay, so net income is the officially recognized bottom line, but our sources take us even further, breaking net income into different components, starting with income from continuing operations.
Yes. And for a lot of companies, this figure is often the same as net income, but the concept itself is really profound. Income from continuing operations is considered the best measure of sustainable profitability.
Sustainable. So when analysts are trying to predict what's going to happen next year, This is the number they look at
This is the one they focus on.
because it strips out all the weird, one-off stuff that won't happen again. You're trying to see what the core ongoing business is actually generating.
Precisely. You have to exclude things like results from discontinued operations, segments of the business that have been sold or are being shut down. And though it's very rare now, extraordinary items.
So if some huge conglomerate sells off its entire European division, that's a massive event.
Huge. And the profit or loss from that sale is critical information, of course, but it shouldn't distract you from understanding what the remaining continuing part of the business actually earned.
Okay, now, let's go even beyond net income to find the broadest, most complete measure of a company's success. This is where we get into comprehensive income.
This is where the true deep dive happens, I think. Comprehensive income is the broadest possible measure of the change in a company's total economic wealth.
And what's so fascinating here is that it recognizes that changes in wealth can happen even if a transaction hasn't been, officially realized through a sale.
Wait, how does that work? If the company hasn't actually sold an asset, how can it be recognized as a change in wealth?
Because the accounting standards acknowledge that some market fluctuations are just so significant they have to be reflected in the total equity of the company, even if they bypass the traditional income statement.
So there's a simple formula then. Comprehensive income equals net income plus this other thing called other comprehensive income, or OCI.
Right. So what on earth is in OCI, and why is it kept separate?
OCI basically captures certain unrealized, paper gains and losses that affect the company's equity but were deliberately kept out of net income.
Why keep them out?
Mostly to prevent volatility. I mean, if these items were run through net income, a company's reported profit would swing around like crazy every time the stock market moved. It would make the core operating figure almost useless.
So OCI is like a holding tank, a reservoir for market fluctuations that we know are real changes in wealth, but we don't want them messing up our calculation for earnings per share or our operational comparison.
That's a great way to put it.
So what are the big examples? What kind of things end up in OCI?
The sources cite two main categories. First is unrealized gains and losses on certain types of investments, specifically what are called available for sale securities.
For example.
So if a company owns a huge block of, say, Amazon stock, and that stock goes up in value by $20 million, well, the company is economically $20 million richer, but they haven't sold the stock. It's an unrealized gain.
So it goes into OCI.
Straight to OCI, not net income.
Okay, that makes sense. It's a paper gain. What's the other big example?
Foreign currency translation adjustments. If a U.S. company has a subsidiary in Europe and the euro suddenly gets much stronger against the dollar, the value of that European subsidiary's assets, when translated back to dollars...
Suddenly increases.
Right, but that gain is unrealized until they actually sell or liquidate that foreign operation, so it also goes into OCI.
So the key distinction between the famous net income and this total measure of wealth, comprehensive income, it all hinges on whether a gain or loss is realized and recognized in net income, or if it's unrealized and just reported in OCI.
Precisely. Comprehensive income gives you the full total economic effect, including all those paper changes. Net income is restricted to transactions that have actually crossed the finish line. It allows you to see both the operational performance and the hidden changes in economic value that are sitting just outside the core business.
This has been a fantastic walk through the entire architecture of profit. We started with that fundamental philosophy, financial capital maintenance, which defines profit as just an increase in nominal dollar net assets.
And then we built the income statement on top of that. We moved from gross profit, which is just raw production efficiency, down to operating income, which is that pure measure of operational success.
And we close with the number everyone knows, net income, the result of all realized transactions, before finally expanding our view to the broadest measure, comprehensive income, which brings in those unrealized paper gains and losses.
So what does it all mean? I think it means we now understand that profit isn't one thing. It can be a measure of management sufficiency with operating income. It can be a measure of completed success with net income. Or it can be this broad view of total economic change with comprehensive income. Each number tells a different, really important story.
Which brings us to our final thought for you to chew on. If a company reports a strong net income, let's use our $50,000 example, but at the same time, it reports a massive negative other comprehensive income, or OCI, because its investment portfolio crashed. Which number should you trust more for long-term stability? Is a company truly stable if its net worth is eroding due to market forces, even if its daily operations seem solid? Consider how recognizing those unrealized paper losses really impact your assessment of a company's true economic footing. That's the power of looking beyond just the bottom line.